Good morning, everyone. Good morning. Okay, I want to welcome you all to this training session, which is on financial planning and bookkeeping. The training session for the two, financial planning and bookkeeping. My name is Henry Chichuku, just like the coordinator has already made the introduction at the WhatsApp group. So today's course objective is expected that at the end of the training session, the participants should be able to, one, understand financial planning activities, what we mean by financial planning, and all the activities that is constituted among financial planning. Secondly, you should be able to differentiate long-term from short-term financial plans. We'll try to see how long-term financial plans differ from the short-term financial plans. Thirdly, you should be able to understand the reasons for bookkeeping, main objectives why companies maintain their financial records and bookkeeping. Then fourthly, identifying bookkeeping methods. You should be able to identify the various bookkeeping methods available. We shall also be looking at the basis of accounting. Another objective, course objective, is how to record financial transactions in our books, whatever record we maintain, be it manual or computerized accounting system, how to record our financial transactions as they occur. So we understand some of us may not have the accounting background, but at the same time, we'll see how these things are done. And then lastly, we'll see how we can balance our books, or we can balance our financial records or financial reports. Let me start off by telling you that you can't run a successful, healthy business without having your books in order. It's like driving a car that has no fuel gauge or map. You know what happens when you drive a car that has no fuel gauge or map? Sooner or later, you discover that you have probably run out of fuel. When a car goes out of fuel, the car will be forced to be pushed aside or pulled away. The same thing, this same analogy applies to business. Let me say that you cannot run your business successfully if you do not maintain a good and healthy financial records. Likewise, if you don't plan your finances. So financial planning is very key to the success and growth of a business. Likewise, bookkeeping, record keeping of all your business transactions. What then is financial planning? Why do we engage in financial planning? Financial planning is the plan needed for estimating the fund requirements of a business, and also determining the sources for the same. The whole act of trying to estimate how much in terms of naira and kobo needed for a business to be set up, having identified how much is needed for the business to be set up, you need to also identify where the money will be gotten from. That is the sources of the fund. Having identified that, you also need to identify when the funds will be needed for injection into the business. So these are some of the areas, gray areas, that financial planning activities seeks to cover as we engage in financial planning activities. So it essentially includes generating a financial blueprint for company's future activities. When a company plans its finances, the company is trying to generate or decide how the financial activities of the company should be run in the nearby future. That's what we mean by financial planning. Identifying, one, how much is needed for the business to conclude. Secondly, deciding on where the money will be gotten from. And thirdly, ascertaining when the money will be most needed for injection into the business. So all of this area is what we refer to as financial planning activities. So the question to ask is, why do companies engage in financial planning activities? Here are some of the objectives of financial planning. Main reason why companies indulge in financial planning activities. One, ensuring availability of funds. For you, it's not just enough that you have envisaged that business of yours. You need to also ensure that the funds are readily available for injection into the business, because funding is very key and crucial for every business success. Your business to thrive, you need to support it with, you need to support that idea, that vision with funding in order that you turn it from vision to reality. So ensuring that the funds are available is one of the major or cardinal objectives of financial planning. Then secondly, estimating the time and sources of funds. Like we said earlier, it's not enough that you, the business promoter, you have identified the type of business you want to do. You have also identified how much is needed. You must also go the extra mile of identifying the timing when the money will be needed for injection into the business, and also where, that is the source of the fund for injection into the business. So these are some of the areas of gray areas that financial planning activities seek to address. Then thirdly, generating capital structure for the business. When we talk of capital structure, we are referring to the splits of the total fund injection into the business between what we call equity and debt. Let me explain. A capital structure, imagine the business you intend going into will require a lump sum of 10 million naira. That's the total capital sum that is needed for the business to be set afloat. Out of that 10 million, if you and every other shareholders are contributing, say, 6 million out of this 10 million that is needed, the shareholders rally around to bring 6 million for the business to be kickstarted. The balance, that 6 million is what we refer to as equity. Any fund contribution by the shareholders and every other persons we call equity participants, promoters of the business. Whatever fund they bring to the table, whatever fund they inject into the business, we refer to it as equity. So out of this 10 million, the shareholders have contributed 6 million, sorry. Then the balance of the 4 million will definitely come as a debt, a borrowing, a liability, or loan, as the case may be. So now go and take the 4 million as a loan, which we are probably looking up to NISA Microfinance Bank to advance us this loan so that it can be injected and plugged into our business. So generating a capital structure is very, very important in financial decision making. That's why we consider it as a cardinal objective of financial planning, because you need to be very strategic in deciding this capital structure, so you don't allow debt or loan to outweigh the equity portion of the fund. Because if the debt, the amount that is being borrowed, outweighs the equity being contributed by the shareholders, the business is said to be highly geared. The business is exposed to all manner of risks: risk of takeover, risk of liquidation, risk of insolvency, if the shareholders and owners of the business fail to repay the loan that has been taken from the lending institution. So we have to be very careful while deciding on the capital structure of our businesses. And lastly, avoiding unnecessary funds from being tied up. This is another reason or objective why financial planning activity is so important, in order to ensure that funds are not just taken up and tied, but funds are taken up and injected into the business when they are most needed. Every fund that is taken up, every fund that is sourced into a business has what we call cost of borrowing. There is usually cost of borrowing attached to every fund that you want to inject into a business. If you are taking the loans from NISA Microfinance Bank, of course, you know the loans are not free of charge. There are interest elements that you, the business owners, will have to bear. So in order to cushion the effect of this borrowing cost, the finance cost, you need to time the injection of the funds so that you don't just borrow funds, take funds from any lending institution or money market when the funds are not immediately needed for injection, thereby leading to interest payments and all that, and finance charge payments. So these are some of the objectives of financial planning, why companies engage in financial planning activities. We have basically two types of financial plans. We have one, the long-term strategic financial plans. The long-term financial plans consider a number of financial activities, which includes one, proposed fixed assets investments, research and development activities, marketing and product development, capital structure, and sources of financing. Let me give you an instance using the first one, proposed fixed assets investment. If a company is considering the acquisition of a fixed asset in a company, what we refer to as fixed asset. What is fixed asset? Fixed asset are those items belonging to a company which is expected to over 19 years. That is over 12-month period. In other words, we are saying that fixed assets are those items of a company which may likely live more than 12 months, and they are used for generation of what we call future economic benefit to the company. A good example is if you are involved in farming activities, your fixed asset will be, a good example of a fixed asset will be your tractor, your farming tools and implements. Those are your fixed asset because the tractor is expected to generate you what we call sales, future economic benefit, income. That's what the tractor is meant to generate to you. And the tractor belongs to you, the company. And having the tractor as part of your asset is also expected that the tractor will last beyond 12 months period. So this is a clear case of a fixed asset investment. So if management of your company is deciding on how to finance the purchase of a tractor, being an example of fixed assets, the options available or that may be available to your company will be one, either option one, buy the tractor outrightly. That's if the liquidity is there, if the cash backing is there. They want to cut check to the vendor who supplies the tractor, or you go to the open market and buy the tractor. That's option one. Option two would be financing the tractor through hire purchase, thereby making payments in installments. We call it finance lease. You have to finance the assets through a finance lease where you agree with the seller or the vendor or the manufacturer to allow you to pay the amount in installments. So taking any of these decisions is what we refer to as long-term financial plans, using an example of this proposed fixed asset investment. So in most cases, for us to know that a plan is of a long-term financial plan, we basically consider the number of that the plan is meant to cover. If a plan is meant to address issues of a company that borders up to 3 years and above, you certainly know that such type of plan is of a long-term financial plan. But on the other hand, if the plan addresses concerns that borders between 1 to 2 years, you do know that it is a clear opposite of long-term financial plans. And what we call that type of plan is short-term financial plans. So these plans are generally supported by a series of annual budgets, profit plans. So we are saying, in addition to having a 3-year, 4-year, 5 years financial plan, it is also very necessary and important that you draw up the annual plans, because it is from these annual plans that we aggregate and cumulatively make up the long-term strategic financial plans. Then the other type of plan is the short-term financial plans, short-term or operating financial plans. Short-term operating financial plans specify short-term financial actions and the anticipated impact of those actions. They typically cover 1 to 2 operating period, like we said earlier. So if you consider a plan that addresses issues of 1 to 2 years, you know that such plan is a short-term operating financial plans. But the moment the plan addresses concerns of a company that ranges from 3 years and above in terms of the duration, you know that such plan is of a long-term financial plans. So for short-term financial plans, a good example of short-term financial plans would be the management of the working capital, a company's working capital. What we refer to as working capital. Examples of working capital are the current assets and current liabilities company. Current assets are those items belonging to a company which can be converted to cash within 12 months. Example, trade receivables, what is usually referred to as trade debtors. If a company has trade debtors among its current assets, trade debtors are those who buy on credit, thereby owing a company. So imagine having a trade debtor, trade receivable, who is owing your company, and you are considering how these trade debtors will be managed in the next 1 to 2 years. Some of the options that will be available to you will be, should you allow the trade debtors to owe your company, or should you even have a standing order that all sales must be made on cash, thereby resulting to no trade debtors? Another option would be, if you are allowing a credit period, how many months or what is the duration of the credit period to be allowed? I mean, should you allow a credit period of 1 month or maximum 2 months for you to be owed? So in an attempt to take all of these decisions, they border on short-term financial plans. Also, deciding on the policy of how your current liabilities are to be managed, such as how trade payables, I mean your creditors, those you buy on credit, how long they should be owed before they are eventually settled. Inventory also, how to manage your inventory. Inventory is also a working capital. How you are to manage your inventory. If you buy the goods, should you allow the goods to stay for a while before they are eventually sold and all that? Your inventory replenishment technique, how your inventories are to be replenished. So all of these activities border on what we call short-term operating financial plans. But the key catch here is for you to understand the time frame that the plans cover. Just like we said earlier, if the plan covers a period, if the plans cover financial activities that borders on 3 years period and above, you know that such plan is a long-term financial plan. But if it addresses concerns of 1 to 2 years operating period, you know definitely that it is the opposite of the long run, and it is a short-term operating financial plan. Okay, so even as we have talked about financial planning, there are certain tools that will be most beneficial to you in planning your finances. Example of those planning tools is cash budget. Cash budget is very, very critical and crucial in deciding and preparing your financial plans. Cash budget. What then is cash budget? Cash budget is a statement of a firm's planned inflows. Cash budget is a statement of a firm's planned inflows and outflows. So when you aggregate all the cash inflows that you are to receive, what we refer to as inflows, all the sales, all the revenue, cash sales that you probably receive over a period of time, then you also aggregate all the payments, cash payments that will be made. That's the total outflow, cash outflow. It's expected that the inflow will be netted off from the outflow, leaving us with either surplus cash budget or shortfall cash budget. Every rational investor will always want to have a surplus cash budget, because Surplus cash budget guarantees adequacy of cash and liquidity. That's what surplus cash budget does. When you have a surplus cash budget, it simply connotes that you have some funds available to the business for the business to thrive. But if a company has a shortfall in its cash budget, it means that the company will struggle in terms of liquidity. The company may not have enough resources at its disposal to meet up with short-term debt when they fall due. So the emphasis here is for us to always strive to have a surplus cash budget, meaning that when you prepare your cash budget, when you carry on your activities, you must always strive that all your total inflows, total cash generation, total cash sales for a particular period must exceed how much you want to spend. That's the total cash outflow. That is the check here. So always ensure that your total cash inflows exceed your total cash outflow to give you some margin of safety, ensuring that cash is always available for the business to run efficiently. But even as we try to guarantee availability of cash, as we try to maintain a healthy liquidity position, it is also not advisable that you stock up cash or you pile up cash and cash equivalent in its liquid form in anticipation that debts will be met. Don't forget, we said every fund, every cash that you have at your disposal has attendant cost of borrowing. There is cost of borrowing attached to every fund that you inject into your business. So you have to gauge and minimize the cash holding in order to ensure that the amount you hold in terms of cash is not too high and is not too little for you to operate. So cash budgets are typically prepared monthly. You see some companies, they prepare their cash budgets monthly, and from monthly cash budget, they translate it to annual cash budgets, as in terms of yearly cash budgets. So here is a step budgeting cycle. This is the cycle that is involved in budgeting. If we want to budget any activity, these cycles are most appropriate for budgeting any of our financial activities. Number one is performance planning. We have to plan our performances very well. What do we refer to as performance planning? While planning our performances, we have to set the goals and objectives of the company. So it's very critical that number one thing to do while budgeting your activity is to plan your activity, plan the goal, ascertain the goals, the main reason, the main objective for being in business. That's the number one thing to establish. And having identified the goal, the objective, you have to provide a frame of reference. Frame of reference is very, very crucial, very key. And what is frame of reference? You have to decide on the benchmark, realistic benchmark. While setting the goals must be as realistic as possible. It makes no sense for us to have goals or objectives that are totally unrealistic. So while setting the budget, while designing the budget, it's most advisable that we make the budget to be such that will be attainable. Attainable budget is most advisable. Let me give you an instance. You want to farm. Say, oh, after the farming season, from the 2 hectares of land you have cultivated, you probably want to harvest 10 tons of maize, 10 tons of maize. And on the average, 1 hectare of land can possibly give you at most 2 hectares of maize. So maximally, the 2 hectares is expected to give you 4 hectares of maize if all things pan out well. But it makes no sense when you start projecting and setting your objective that your harvest, your yield for that particular period has to be 10 tons, which means that your budget is totally unrealistic. So we have to provide a frame of reference, a benchmark that helps us decide on the attainable goals and objectives. And thirdly, we go into the implementation proper. Third cycle under the budgeting is implementation. Going to implementation, like the instance I gave you, the farming activity, the implementation will be now engaging in the planting activities and all the planting processes. And once that is done, once the implementation is done, we now investigate variations. Investigate variations by inquiring to know the reasons why the planned budget differ from the actual results. Actual results are from plans in two ways. The result can either be favorable or adverse. It is favorable where the result pans out well than what has been projected or what has been budgeted. But it is adverse or unfavorable if the actual result is far below than the target that has earlier been set. So once we investigate variations, we know the reasons, especially if you have unfavorable budgets, adverse budgets, you need to launch investigation into the variation. Why was it that, yes, 4 tons of maize was anticipated as a goal for this planting season, and at the end of the farming season, you can only boast of 2.5 tons of maize, meaning that there is a variance of 1.5. So you need to launch investigation into the possible causes of the variation. Some of those investigations will be probing to ensure that you planted earlier enough during the planting season. Some of the investigation activities will also include investigating if the right inputs, right farm inputs, maybe the maize you planted were of the right quality, the seedlings you use were of right quality, the fertilizers you use, you need to also prove them if they were of the right quality and all that. So this is what we mean by investigating variations, because all of this is to ensure that in the nearby future, when you repeat the same farming activity again, you will have a successful outcome. I mean, whatever goal you set will have to be achieved. And the other step under the budgeting cycle is you take corrective actions. Corrective actions will be forestalling, making sure that those things that prevented the attainment of the earlier goals you set will have to be forestalled. I mean, you take corrective actions by making sure that if you planted late in the farming season, during the last farming season, that you plant a little bit earlier this time or the next coming farming season. If you used a poor farm input, you make sure that you use a standard farm input this time. It will help you attain the goals that have been set. And finally, we plan again. So budgeting is a continuous process. When we plan the budget, we go into implementation proper. After implementation, we take stock. This is where we now investigate the variations, what the possible reasons, while actual results differ from the plans. Then we plan again. So budgeting is a continuous process. When we plan and plan again. So we have basically 2 types of strategy analysis. We have the long run strategy and the short run strategy. Just like the name suggests, if you are considering to deploy the long run planning or the long run strategy, it is advisable that you use the long run budget in attaining whatever objective that you have, whatever financial objective that you have. Also, if you want to address the short run strategy or the short run planning, you need to make use of the short run budget, the budget that covers a period of 1 to 2 years. If your plan is of a long run, don't forget, like we said, the long run plans cover a period of 3 years and above. It's expected that your budget also to be drawn up should be for a period of 3 years and above. So depending on the strategy that you have, you decide on the tool to be deployed into the business or into your financial planning activities. So there's what we call cycle of money. Cycle of money. The primary function of finance is the movement of money from lenders to borrowers and back again. This is referred to as cycle of money. Every fund that is injected into every business tends to rotate That's what we refer to as cycle of money. Let me give you an instance. If you successfully secure the loan from the National Microfinance Bank, discover that the loan will be paid into your bank account. In other words, the fund is injected into the business. So the fund comes into the business. And as the fund comes into the business, you make payments for goods or services that you buy. You also pay for salaries and wages to help you produce goods or services. So you discover that the fund that came in from National Microfinance Bank eventually finds its way out when you make payment for goods and services and for salaries and wages you have consumed. And immediately the money goes out, you produce goods or services, and these goods or services are in turn paid for by your customers. And as customers pay for it, the money that went out returns back to the business. So this same cycle keeps repeating itself. And that is what we refer to as cycle of money. That's why we say the primary function of finance is the movement of money from lenders to borrowers and back again. That's why it's referred to as cycle of money. So don't forget that every fund that is injected into a business tends to rotate. It comes in and out of the business. Now let's consider bookkeeping. Let's look at bookkeeping. What is bookkeeping? Bookkeeping involves the recording on a daily basis of a company's financial transactions. The whole act of documenting, recording any financial transactions in terms of naira and kobo that transpires within a company is what we refer to as bookkeeping. So with proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financing decisions. So bookkeeping is very, very important for operating, investing, and financing decisions of every company. That's what bookkeeping does. Who are bookkeepers? Bookkeepers are individuals who manage all financial data for companies. Without bookkeepers, companies would not be aware of their current financial position, as well as the transactions that occur within the company. So bookkeepers are those whose responsibility is to manage the finances, to keep records of all financial transactions that happen within a company. So it's expected that if your company is large enough to afford the services of a bookkeeper, you're advised to do so, to engage one. But if you cannot afford the services of a bookkeeper or an account clerk, not to worry. Before the end of this session, I will show you or reveal to you how to maintain your books, how to maintain your financial records, even as non-accountants. Okay, so here are the importance of bookkeeping. These are some of the reasons why companies engage in bookkeeping activities. 1, bookkeeping provides a reliable measure of a company's performance. If you want to measure a company's performance, how well a company has operated over a period, the best you can do is to refer to its accounts, its bookkeeping records, whatever financial reports that have been kept by the company or that has been maintained by the company, you make reference to it. So for you to ascertain if a company is making progress in terms of profitability or the company is making losses, you need to make reference to their financial records. And these financial records are in turn generated from bookkeeping activities. Then secondly, bookkeeping provides information for strategic decision making. Every manager, every business owner want to, at every point in time, take what we call strategic decisions. So if you maintain your books in place, you keep financial records in place, you are able to take key strategic decisions. Let me give you an instance. Imagine if you have two operating segments. You have two lines of businesses. One of the lines is that, probably you farm crops. You are farming maize on one hand, and on the other hand, you are rearing animals. You are rearing animals, maybe goats, for instance. So you see, you have two operating segments. One of the segments is crop cultivation, and the other segment is animal farming. So part of the strategic decision you can make is at the end of the farming season, you may want to take decisions to evaluate how far you have done in terms of these two operating segments to see if it is the crop cultivation that earned you enough returns, adequate returns over the farming period, or it is the animal farming that earned you enough returns. So some of the strategic decisions you may want to take will be closing down on any of these operating segments that never brought enough returns to you. You may decide, oh, the crop cultivation didn't give you enough returns. It didn't reward you adequately. You may want to discontinue or stop the crop cultivation and channel all resources and energy into the animal farming. So that's what we mean by a strategic decision. And how do you evaluate that this particular operating segment is bringing enough returns more than the other one? You have to make reference to your bookkeeping, whatever financial records that you maintain. Then thirdly, bookkeeping provides benchmark for revenue and income goals. So bookkeeping will tell you where your revenue and income are to be sourced from. And once you identify your revenue earning activities, you pursue them rigorously. That's what bookkeeping activity does. And fourthly, fulfillment of legal and tax obligations. When you maintain your financial records, you keep financial records, you discover that you are able to comply with all legal and tax obligations. When the tax authority comes, by then, because you maintain adequate bookkeeping, you are able to furnish the tax authorities with your bookkeeping, your records, your financial records, and thereof, your tax liabilities can be computed. Tax liabilities can be computed. That's what bookkeeping does. Then the fifth one is it provides stewardship to investors. When a company maintains its bookkeeping activities, the company is able to report to the investors, the shareholders who have invested their funds. Don't forget that modern day business is such that the investors are different from the managers. Investors are those who have contributed their funds for the business to be set up, while the managers are those who are charged with the day-to-day running and administration of a business. So the only way that the managers who are entrusted with the day-to-day running of the business can provide or render stewardship function, accountability function to the owners of the business, that's the investors, is by maintaining adequate bookkeeping, by providing bookkeeping records, adequate accounting records. And lastly, bookkeeping helps with proper management of cash flows. Companies that maintain their bookkeeping tend to manage their cash flows properly, because when you maintain your bookkeeping activities, in fact, you align your budgets with your activities as they progress. And once you align your budget with your real activities, you are able to cut down on unnecessary expenditures. Expenditures that are not necessary for income generation in the business are totally avoided, and that will help you to properly manage your cash flow. So these are some of the importance of bookkeeping activities, reasons why companies engage in bookkeeping activities. Accounting basis. There are basically two bases of accounting. What is accounting basis? When we talk of accounting basis, what are we referring to? Accounting basis refers to that period of time that accounting transactions must be recorded. If a transaction happens now, should that transaction be recorded now, or should it be recorded at a later date? That's what we mean by accounting basis. When should an accounting transaction be documented by a company? So we basically have two bases of accounting. Number one is the cash basis, and the other one is the accrual basis. Let's consider the cash basis. Cash basis of accounting is an accounting basis that records transactions only when cash is actually received or paid. In other words, transactions are recorded by a company only when there is a cash movement. When the company receives cash, either in terms of revenue or sales, the company goes ahead to record that transaction. When a company makes expenditure, incurs expenditure, and cash leaves the company then at that point records that particular transaction. So in this case, under the cash basis, accounting transactions are not recorded until there is movement of funds, meaning that if fund does not move in or out of the business, accounting transactions are not to be recorded. Let me give you an instance. Imagine selling your product to your customer, and the customer of yours is promising to make payment in 1 month's time, meaning that that fund will not be received by you now. The fund will be received in 1 month's time for the sales transaction, for the supplies you have done now. If you look at it, because payment will be received in 1 month time, according to this accounting basis, which is the cash basis, you don't record that transaction because cash has not exchanged hands. It is only in 1 month's time, when you eventually receive that money, that you can then record the sales transaction. By then, the money would have been received by you, meaning that emphasis here is on cash movement. The same thing applies to purchases. If you buy goods on credit and you are promising to pay the supplier in 2 weeks' time, the fact remains that payment is due in 2 weeks' time. Even as you have taken deliveries of the goods, you don't record that accounting transactions in your book until in 2 weeks' time, when you eventually cut the vendor check or you do a transfer to credit the vendor for the goods you have purchased. It is only that time that the credit, the transfer, the funds have moved from your account to the vendor account that the transaction can then said to be recorded, because you operate using the cash basis of accounting. Then the other one is the accrual basis. Accrual basis takes the opposite term of the cash basis of accounting. Under the accrual basis of accounting, accounting transactions are recorded when they occur, even if cash is not received or paid. So emphasis under the accrual basis is not on the movement of cash. Rather, emphasis here is on the occurrence of the transaction. If a transaction occurs, a transaction can occur even without the money moving the company, leaving or coming into the company. Let me give you an instance. The other instance I told you that you made purchase, you bought goods from your vendor, your supplier who supplied you goods, and you are promising to make payment in 2 weeks' time. The question to ask is, has this transaction taken place? The fact that you have taken deliveries of those goods that your customer supplied to you, it therefore means that the transaction has taken place. And if you operate using the accrual basis, for the fact that the transaction has taken place, you have to record that purchase transaction in your books. So here we don't wait until cash is either received or paid by the company before accounting transactions are recorded. Rather, we look at the occurrence of the transaction. Once the transaction has occurred, irrespective of the fact that money has not been received or paid, we go ahead and record or book that accounting transactions. So I have an example before us. This example says you purchased 100 units of a product and you will pay for it next month. You have purchased 100 units of product and you will pay for it next month. So under the cash basis of accounting, emphasis here is that payment will be made next month. So if payment will be made next month, it therefore means no transaction has to be recorded now under the cash basis, because the cash basis relies on the movement of funds for the transaction to be recorded. So since money or fund has not exchanged hands, therefore means that the accounting transactions, the purchase of this 100 units of product will not be recorded. It will be recorded next month when the payment is made. But under the accrual basis, this purchase of 100 units of product will have to be recorded. You record it. Because for you to take deliveries of these 100 units of product, it means that the transaction has occurred, irrespective of the fact that money has not exchanged hands. The funds have not exchanged hands. So in this instance, we have to record the accounting transaction. So I want to believe that we now know the difference between the cash basis of accounting and the accrual basis of accounting. Under the cash basis of accounting, don't forget that emphasis is on cash movement. As cash moves in or out of the business, the transaction is being recorded. But under the accrual basis, as the transaction occurs or takes place, the accounting entries are made. The accounting transactions are recorded, even if cash has not been received or paid by the company. So the point I want to make here quickly is that the cash basis of accounting and the accrual basis of accounting cannot be used simultaneously. You cannot use both the cash basis of accounting and the accrual basis of accounting in maintaining your account. It is not possible. You have to decide on which one among the two to be deployed. In other words, if you adopt the cash basis of accounting, it's expected that this cash basis of accounting must be applied consistently. If you adopt the accrual basis of accounting, it's also expected that this accrual basis of accounting has to be applied consistently. You cannot adopt the cash basis of accounting this year, and next year you want to switch to accrual basis of accounting. It is totally forbidden. You are not permitted to do that. The whole essence of restricting a company from the use of the various accounting bases is to ensure that financial statement of one year becomes comparable with that of another year. Because if you use cash basis to record a particular transaction this year, maybe all your sales, you use cash basis to record it this year, and next year you now use accrual basis to record all your sales, you discover that the financial report, your sales value for year 1 and year 2 will greatly differ, thereby making the 2 years financial statement incomparable. So any of these accounting basis that is adopted has to be applied consistently. Take note. So have methods of bookkeeping. There are 2 methods of bookkeeping. We have the single entry bookkeeping method. Under the single entry bookkeeping method, it is straightforward method where one entry is made for each transaction in the books. So a company that uses the single entry bookkeeping, does its accounting transaction in a straightforward manner. Recall I told us at the beginning of this class that before the end of this session, I will show us how to maintain accounts, how to maintain our books of accounts, even as non-accountants. Even as non-accountants, you can maintain your books of accounts. How do we do that? Using the single entry bookkeeping, you can decide to create a hard column book. You maintain a hard column cash book where you record all transactions that happen. All your transactions, you record them in your notebook. That alone is an act of bookkeeping. Some companies may buy what we call analysis column cash book. Analysis column cash book, usually sold at the bookstores. It has various columns So under each of the columns, you may decide, oh, this first column, I want to record all salaries and wages payments. The other column, I want to record all transportation expenses during the year. The other column, I want to record all utility payments during the year. The other column, I want to record all repairs and maintenance expenses during the year. So that in itself is a single entry bookkeeping method, which you can adopt even as non-accountant, and your books will be intact. You maintain your financial records. In fact, when you use this approach we have mentioned now, you don't need any form of accounting knowledge. You don't. All you need to do is, as the transactions take place within the company, you record them, you book them. That is the single entry bookkeeping. That's why we said it is relatively straightforward. Some companies also may use their check stub as their bookkeeping method. For those of us who know check stub, the small leaf that is left on the check booklet, the moment you tear the check leaf, the small leaf that is left on the booklet. I also see people, mainly they make or issue checks, they write the narration on the check stub, clearly showing what the payment relates to and what the transaction is all about. This is to help them at a future date when they want to prepare their financial report, they can lay hold on the bookkeeping they have maintained, which is the check stub. So that's why we said it is single entry bookkeeping and it is straightforward. Then the other method of bookkeeping is the double entry bookkeeping. Under the double entry bookkeeping, this is more robust. It follows the principle that every transaction affects at least two accounts. Every transaction affects at least two accounts. And they are recorded as debits and credits. They are recorded as debits and credits. So for every transaction that happens in accounting, we say there is a debit and there is a credit entry. So you must have these two entries. And for you to use the debit and credit entries, you must have some form of accounting knowledge. So if you don't have any form of accounting knowledge, if you cannot afford the services of a bookkeeper or an account clerk or a qualified accountant to maintain your books, your financial records for you, and use the double entry bookkeeping, you are strongly advised to stick to the single entry bookkeeping method, which is the first one. But if you can afford the services of an accountant, you can use the second one, which is double entry bookkeeping. Because sometimes it can be very confusing, where we have to struggle between which account is to be debited and which other account is to be credited. So let's consider this example. If you sell a bag of cowpea for 20,000 naira, cowpea is beans. You sell a cowpea for 20,000 naira. The analysis, the debit entry and the credit entry in this case will be you debit your cash if you have received cash. If your bank has been credited, if your bank, the money has been paid into your bank, you debit your bank and you credit your sales account. You credit your sales account. So you can clearly see that for this transaction, which borders on sale, two account balances are affected here, which is a cash or bank account and the sales account. Accounting systems. Accounting systems are designed to collect, document, and report on financial transactions affecting business. So any system that is designed to collect, document, and report on financial transactions affecting business, that system is referred to as accounting system. We have basically two types of accounting system. We have the manual accounting system and the computerized accounting system. Under the manual accounting system, accounting transactions are basically processed by hands. You use your hands to process your accounting transaction. And a good example of the manual accounting system will be having the analysis column cash book, which we talked about, having the hardcover notebook, which you basically record or book all your transactions. So this is the manual accounting system, because you have to rely on the manual means of recording your accounting transactions. Then the other one, the computerized accounting system. Under the computerized accounting system, financial information is recorded by entering it into a computer. Under the computerized accounting system, financial information is recorded by entering it into a computer. In this case, we rely on the use of computer to maintain our accounts. So, example of the computerized accounting system would be when you deploy your Excel, your spreadsheets, that helps you record or book all accounting transactions. Because you are doing this with computer, with the assistance of a computer, it is referred to as computerized accounting system. The other example of the computerized accounting system will be the use of accounting softwares like Sage, History, QuickBooks, Tally, and the likes. So when you use any of these accounting softwares, it means your accounting system is being computerized, because you basically process them by the use of a computer. You quite agree with me that the computerized accounting system will tend to be more efficient, more accurate than the manual accounting system. Yes, that is correct. The computerized accounting system will tend to have more efficiency, more accuracy compared to the manual accounting system. But even at that, we need to also be careful while using the computerized accounting system, because there's what we call GIGO, garbage in, garbage out. Computer, yes, they are reliable, but even at that, we have to be sure that the input, the data that we key into the system is accurate. Because any mistake, if we mistakenly key in a wrong data or information into the system, it means that the reports, accounting reports to be generated, will also be inaccurate. So even as it has been said that computer systems are more reliable, the computerized accounting system tends to be more reliable than the manual accounting system. We also need to be very careful in making entries into this system. So you have to understand the basics of bookkeeping behind what you do or what you enter into the computer program in order to enter the current information. Accounting systems. Still on the accounting system, there's what we call GAAP, Generally Accepted Accounting Principles. GAAP, Generally Accepted Accounting Principles. GAAP refers to all rules, regulations, norms, principles which accountants are to abide by while preparing financial reports. So all manner of rules, accounting standards, principles, policies that accountant has to make reference to while preparing financial reports is referred to as GAAP, Generally Accepted Accounting Principles. And these set of rules are set by Financial Reporting Council of Nigeria, FRCN. FRCN is responsible for setting up, for designing, for adopting these rules and policies to be followed by all reporting accountants. GAAP is very, very useful in preparing accounts, because if there is no GAAP, if there is no generally accepted accounting principle, discover that the financial information that may be produced will. Let me give you an instance. If you prepare accounts for a proprietor or a business owner will want to prepare the account to show that profit for the year is little. And when profit for the year is little, it means little or no taxes will be paid for the year. But when you have these rules, generally accepted accounting principles that guide users, that guide accountants in preparing accounts, it guides accountants in preparing these financial reports to be sure that the accounts prepared are faithfully represented, that the accounts are unbiased. So that's why we must pay attention to the generally accepted accounting principles. While another user of financial statement, take for instance, a manager who is entrusted with the day-to-day administration of the business, simply because the reward system for the manager is incentive-based, based on how much profitability is able to make. In most cases, you discover that the manager will do everything possible to either window dress the account and ensure that the financial statement shows a rosy and healthy profit level for that particular period, in order that you can enjoy the incentive. So in order to avoid all of this window dressing, creative accounting, we accountants, we as bookkeepers, we must pay attention to the generally accepted accounting principles as set out by the Financial Reporting Council of Nigeria. What is financial reports? Financial reports are summarized information about the financial status of a business. So the end product of our bookkeeping activity is to help us, enable us to generate financial reports. The main reason why bookkeeping activities are maintained is for a company to be able to generate the financial reports thereof. That's why we said financial reports are summarized information about the financial status of a business. And accounting is also seen as a language of business because it is so fundamental to the communication of financial information. Accounting is often called the language of business. The reason why accounting is called the language of business is that accounting tends to address all the issues that borders on the naira and kobo that comes in and leaves every business entity. So we have basically two types of accounting reports. We have the one we call financial accounts, and the other one we call management accounts. Financial account focuses on reporting information to external users. So any report, any accounting report that is prepared to address external users' needs is referred to as financial accounts. External users are those users of financial information who are not members or management or employees of a company. So those who are not involved with the day-to-day running, administration, or decision-making for a company, they are considered to be external users. In the next slide, I will give us examples of who constitute external users. So when these accounts are prepared for the consumption or for the purpose of serving external users' need, we refer to those accounting reports as financial accounts. But when the accounting reports are prepared exclusively for internal management needs, we refer to those accounting reports as management accounts. Management account focuses on reporting information to management, often referred to as accounting for internal users of accounting information. So management account addresses the internal users' needs, those who are considered to be members of the company, such as the shareholders, the managers. Any account that is prepared for this set of people, the managers, the shareholders, the employees, that account is referred to as management account. So what then is the difference between financial account and management account? You discover that financial account is usually an audited account. In most cases, because financial account is to be presented to external users, Financial accounts are usually being audited. External auditors are called upon to express an independent opinion on their accounting reports before they are sent out to external users. So any accounting report that is audited for the sole use of external users, we call such accounting report a financial account. But any accounting report that is unaudited, that is meant for internal users' needs, we call that accounting report a management account. So here are examples of those we call the external users and the internal users. For external users, they are individuals outside the business who have an interest in the business. So any individual outside the business who have an interest in a business, we refer to them as external users. Example of external users that may be interested in the accounting report will be government, entities of government, such as the FIRS, Federal Inland Revenue Service, FCT-IRS. If you are involved in other businesses that require regulation, take for instance, you are involved in pension business, PENCOM being a government entity will require you to furnish your account to them. So these constitute government entities under the external users. General public also will be interested in your accounting reports, especially if your company is a PLC. If you have your shares, your stocks being traded on the floor of the Nigerian Stock Exchange, it means your account, your financial reports will have to be made public. You prepare your account and you publish it either on your website or you share it on the Securities and Exchange Commission's website, thereby making it available to the general public. Civil societies also are part of the external users. Civil societies may be interested in some companies' financial reports. Lenders also, those who provide a company with one form of funding or the other. Example of lender in this instance will be NISA Microfinance Bank. So imagine if you successfully secure this loan from NISA Microfinance Bank. NISA Microfinance Bank becomes a lender to your company. So it therefore means that NISA Microfinance Bank, being a lender, constitutes part of the external users. In other words, your financial report, your accounting reports will be required to be furnished to NISA Microfinance Bank, being a lender. So these are examples of external users. Now for the internal users are individuals inside the business. Internal users are individuals inside the business. Example of internal users are shareholders who are members of the company, the owners of the company, the managers, those who are entrusted with the day-to-day administration or running of the business. They are within the working system of the business. Employees, those who are under payroll, who provide one form of services and are under permanent employment, be it temporary or permanent employment with the company, they form part of the internal users. So these are examples of external and internal users of accounting reports. Let's consider primary accounting reports. Recall we said the end product of our bookkeeping activity is to help us generate accounting reports. The more reason why we indulge in bookkeeping activity is to help the company generate appropriate accounting reports. And some of those accounting reports that can be generated from your bookkeeping activities are 1, balance sheet, 2, income statement, 3, cash flow statement. What the business owns and what the business owes the outside world. Any statement that shows what belongs to a company and what the company owes in terms of indebtedness to outsiders is what we refer to as a balance sheet. So basically, balance sheet is meant to show the financial position of a company. Balance sheet is meant to show the financial position of a company. And that's what we call the balance sheet equation. The balance sheet equation is such that assets minus liabilities must equal equity. Or simply put, we say liabilities plus equity must equal the total value of assets. Let me give you an instance. Assets are those resources belonging to a company. That's what we refer to as assets. So if in your business, every item that belongs to you that has been put into the business, ranging from your land and building, motor vehicle, plant and machinery, your generators, your furnitures and fitting, your ACs, your stocks, inventories that you want to sell, all of them will constitute assets because they belong to you. So if the value of all of these your assets is put at, say, 10 million, it means that this assets has been directly or indirectly financed using either liabilities or equity. You have financed this asset of 10 million using either liabilities or equity. Remember, we said equity are those fund contributions by the owners of the business, by those we consider to be the equity participants. So if the owners of the business have contributed 6 million and you have an asset that is worth 10 million on ground, it therefore means that the balance of 4 million would have been contributed as a liability, a loan, which is a borrowing that the business has taken. So at every given point in time, liabilities plus equity must equal the total value of a company's assets. Now, income statement. Income statement is a statement that is prepared to show in terms of profitability how much a company has made. Income statement is prepared to show the profitability of a company. Preparing income statement, a company aggregates all of its sales and minuses its expenditure. That will leave the company with either profit or loss for the period. Income statement. Then the third one is the cash flow statement. Cash flow statement. Cash flow statement is a statement that is prepared to showcase the liquidity position of a company. The reason why cash flow statement is prepared is to showcase the liquidity position of a company, how liquid the company is. Liquidity is measured by the ability of a company to meet up with its short-term debt when they fall due. So when a company meets up its short-term debts, immediately they fall due, the company is adjudged to be liquid. That's what cash flow statement is out to test, is out to measure. So cash flow statement can either be in surplus or deficit. The surplus cash flow statement connotes that the company has generated more cash inflow than the total cash outflow it has expended during the period. That will leave us with surplus cash flow. But a deficit cash flow suggests that the total cash outflows for the period in terms of how much the company has spent exceeds how much the company has in turn generated during the same period that they relate. So a rational businessman or woman, a rational investor, a rational company will always want to maintain a surplus cash flow statement, meaning that the company has enough cash and cash equivalent at its disposal. So these are some of the primary accounting reports that can be generated from the bookkeeping activities we have discussed earlier. So here is a balance sheet equation. Here is the balance sheet equation I tried illustrating, where we said liabilities plus equity must equal the value of our assets. Liabilities put together with equity must equal the total value of our assets. So Imagine your asset being 10 million. It's expected that your liability and your equity, when summed up, must equal the 10 million as the value of your assets. Income statement. Income statement will start off by revenue. We aggregate all revenue, all sales of the company. They will minus all expenditures of the company. Leave us with either profit or loss for the period. So most of these statements are usually prepared annually. So it's expected that you prepare these accounting reports annually. As the year comes to an end, depending on what your accounting year is, like most people will always want to adopt January to December as the accounting year. So having traded, having carried on your businesses from January to December, then as you are entering the next year, you now prepare account for the year that has just ended. So income statement is usually prepared annually. Likewise, the balance sheet and the cash flow statements. So before us is an example of a balance sheet. This is what a balance sheet looks like. If you notice, we have two sections, the left column and the right column. The left column represents all the assets of the company, while the right column represents all the equities and liabilities of the same company. So under the left column, which is the assets, assets are subdivided into two, the current assets and non-current assets. Assets are categorized into two, current assets and non-current assets. So under the current assets, in fact, what then is an asset generally? Assets are those resources belonging to an entity, which the entity uses to generate sales or revenue. In professional terms, we say it is used for the generation of future economic benefits. So any item in a company's possession which helps or aids the company in earning revenue, in earning sales, we refer to those items as being assets. So the current assets, those assets that will fall under current assets are those assets belonging to a company which is expected to be converted to cash within 12 months after its classification as current assets. You notice that these assets, the current assets, we have cash and cash equivalents, accounts receivables. They are classified as current assets by the year end when preparing this account. So it's expected by the next time a balance sheet will be prepared again, making it exactly 12 months or a year. Most of these items, most of these account receivables will have been converted to cash. So current assets are those items which is expected to be converted or translated to cash within 12 months after its conversion. Cash and cash equivalents, we don't need any form of conversion. It's already in its liquid form. Account receivables. Account receivables are those customers who are owing a company. Like this company, the account receivable represent those who have probably bought on credit from 30FAB Incorporation. This company were analyzing the balance sheet. So those who are owing this company, they are categorized as account receivable and presented under current asset because it's expected that between now and the next 12 months, they would have settled how much they owe this company. That's why they are presented under current assets. Inventory also, what we used to know as stocks. Stocks are items held by a company for the purpose of resale. When you hold an item that you plan to sell, we call it inventory or stock, as it is generally called. So the reason why stock is presented under the current asset is that we expect this stock, this inventory, to be sold and converted into cash within the next 12 months. That's why it's presented under the current asset. Prepaid expenses. When a company makes payments in advance, a company pays for goods or services that it is yet to receive. We call it prepaid expenses. and they are categorized under the current assets. A good example of prepaid expenses will represent when a company pays for 2 years annual rent. Imagine your company paying for 2 years annual rent, and at the end of year 1, the company wants to prepare its financial statements. So the rent that relates to year 2, which the company has not enjoyed the services, will have to be presented under the prepaid expenses. Investments. If a company has investment that is due to mature within 12 months, maybe bonds, treasury bills, and all that, fixed deposits that is due to mature within the next 12 months, they are categorized as current assets. Then, under the non-current assets are those items also belonging to a company, which the company uses for its revenue generation, and they are expected to last over 1 year. A good example is property, plant, and equipment. Under the property, plant, and equipment, you have land and building. Land and building is used for generating revenue for a company, and land and building is expected to last or live above 1 year. Buildings, office equipment, furniture and fitting, plants and machinery, motor vehicle. If a company has all of these items are categorized, the values of these items are categorized as non-current assets because their lifespan exceeds 1 year. Their lifespan exceeds 12 months. And because of that, they are categorized under the property, plant, and equipment. That's the non-current assets. Then we have the intangible assets still under the non-current assets. Intangible assets are identifiable non-monetary items without physical substance. So any item of a company which cannot be seen, felt, or touched, we call it intangible assets. Any item of a company which cannot be seen, felt, or touched, but used for revenue generation, we call it intangible asset. Examples of intangible assets will represent license. Imagine having a license, a fishing license. Such license, you cannot see it, you cannot feel it, you cannot touch it, but the license will help you to generate revenue. So that license qualifies to be treated as intangible asset. Imagine having a software that helps you perform your task. If you have an accounting software that helps you perform your task, that accounting software that has been stored cannot be seen, felt, or touched. It is an example of intangible assets and is categorized under the non-current assets. So let's move quickly to the right section, which is the equities and the liabilities. The right section comprises equities and liabilities. The right section, the liabilities are further categorized into two: current liabilities and non-current liabilities. The word current means that the transaction will take place or materialize within the next 12 months, while non-current means that the transaction will last over 12 months. So under the current liabilities, what is current liabilities? Current liabilities are those amounts, indebtedness of a company to third parties. So if a company is owing other people and the amount is due to be settled or paid back within the next 12 months, they are categorized as current liabilities. Example is accounts payable. So imagine this company that has presented this balance sheet owing its customers whom they have bought from on credit. This account payable, because it's expected to be settled, to be received within the next 12 months, it is categorized as current liability. Note payable, if a company has any loan, the portion of it that is due for payment within the next 12 months comes under current liabilities. Accrued expenses. Accrued expenses are expenses which have been enjoyed by a company, but they are yet to be paid for. So when a company receives goods or services, but the company is yet to pay for it, it becomes a liability, a current liability. Example of this is accrued wages, accrued salaries. Employees have worked, employees have provided salaries, employees have provided services, employees have provided services, and the employees are yet to receive their remuneration by year end. So that amount due to the employees qualifies to be treated as current liabilities. It is an accrued expense. Deferred revenue. When a company receives revenue, from each customer, but the company has not supplied the goods or services for it to earn the revenue. That revenue is treated as a liability, as indebtedness to third parties, and it is presented under current liabilities. Then the non-current liabilities are indebtedness of a company which can span over 12 months. Any indebtedness of a company which cannot be fully settled within 12 months is presented under non-current liability. A good example is long-term loan, long-term debt. Clearly the case of National Microfinance Bank. If you get the loan from National Microfinance Bank, the loan will be presented in your financial statement as non-current liability. It's an indebtedness. That's why it's called a liability. You do know you are owing National Microfinance Bank, and the repayment period is over 12 months. You may have up to 5 months, up to 5 years to pay back this amount that has been borrowed. And because the time frame spans over one accounting year, it then qualifies to be non-current liability. Then the last section of the balance sheet is the shareholders fund. We call it equity. Under the equity, you have balances belonging to owners of the business. The owners of the business are the shareholders. So when you have ordinary share capital that have been issued and subscribed by the shareholders, they come under the equity section. That's the shareholders fund. Retained earnings, all accumulated profits or losses over the years that the company has operated, they all will be presented under the retained earnings. So this is a clear example of balance sheet. And if you look at the left column and the right column, you discover that the total are equal. Don't forget we said earlier that your total assets must equal your total liabilities and equity. It has to be equal for us to say that your account is balanced. Then the next account is the income statement. Income statement, as you can see clearly, it's expected that all revenue earning activities are clearly itemized. All activities that earn you revenue during the year, during the financial year you are reporting, you have to clearly itemize them. You can see client service revenue, sale of books, professional consultation, all of them, you itemize them, showing each of the income from the revenue lines. So take, for instance, you are also involved in farming activity. You farm crops, you farm animals. It's expected that when you prepare your account, part of your revenue earning line item will be income or revenue from crops, and the second one, revenue from animal cultivation. So it's expected that those activities, those revenue earning activities should be presented separately, so that anybody who looks at this account can clearly make an informed decision. After the revenue has been aggregated, that's the sales have been aggregated, then you aggregate all the expenditures. Examples of these expenditures are wages, rent, utilities, salaries, transportation, office supplies, stationaries and printing, telephone, internet, and all that, insurances. These are examples of expenses. Those expenditures you incur in line trying to earn the revenue or trying to earn the sales, they come under the expenditure. So at the end of the day, it's expected that all the expenses should be deducted from your total sales, leaving you with profit before tax. after which you make provision for income taxes. After income taxes have been deducted, you now have profit after tax. I want you to observe carefully that even as this income statement relates to 2004 financial year being the most current among the 2 years, you will also notice that the comparative figure, that's the prior year figure for 2003, is also included in this statement. When we prepare income statements like this, even our balance sheet, it is expected that we must include the comparative figure, the last year figures. The essence is to help users of this financial statement make adequate, informed decision. Anybody who picks up this income statement, this financial statement, will want to see what was revenue last year and what is revenue this year. Has there been any improvement in terms of revenue generation? The person will also want to know what was profit last year and what is profit in the current year, 2004. Has there been any improvement in terms of profitability from where they were last year and where they are currently? So the essence of including comparative figure is to help users of financial information make or take adequate predictive decision. So here are various components of accounts. The basic unit of accounting is an account or general ledger account. It is a unit of information that represents business records. There are 5 types of accounts, 5 components of accounts. We have the assets, liability, equity, revenue, and expenses. So these are the 5 components of accounts, meaning if you want to prepare your balance sheets, you must use some of these components in preparing your balance sheet. If you want to prepare your income statement, you must use some of these components in preparing your income statements. So the first 3 among the 5, which is assets, liability, and equity, these first 3 components are used for the preparation of what we call balance sheets. We have talked about balance sheet before. That statement that shows the financial position of a company. That statement that shows what the company owns and what the company owes outsiders. That's the balance sheet. And the last 2, which is revenue and expense, is used for the preparation of income statement. So income statement is prepared using revenue and expenses, these 5 components. So you discover that a business can have anywhere from a dozen to several thousand accounts, with each one being one of the 5 steps. No matter the accounting transaction that is involved, it must definitely fall between any of these 5 components. You can take examples. If you purchase office equipment, for instance, office equipment clearly will fall under assets, which is the first one. If you make sales, you sell your goods to a customer, that will fall under the 4th item, which is revenue, because sales represents revenue generation. If you pay salaries, that will fall under the last one, which is expenses. So no matter the accounting transaction, no matter the transaction that occurs in your business, they definitely fall within any of these 5 categories, any of these 5 components. So accounting is a process of recording business activities that make changes to accounts. When we record business activities in a manner that account balances tend to change, we say that this is referred to as accounting. And this includes sales of product. Immediately a product is sold, it is being accounted for, and the sales balance will change. Revenue from services end. Immediately a company earns revenue from services it provides, the revenue account balance will change. Immediately a company buys products or services, the purchases account balance will change. If a company incurs other expenditures, maybe repairs, utilities, subscriptions, telephones, the expense lines will also change. If a company depreciates its fixed assets, the fixed asset balances as presented in the financial statement will also change. So any activity that borders on recording business transactions in a manner that makes changes to account, that we refer to as accounting. So when any of these and other business activities are recorded, accounts change in value. So double entry accounting, I remember telling us that because some of us may not have accounting background, may not bother ourselves on the double entry accounting. But I want you to remember one thing: there are two methods of bookkeeping, like we have discussed: the single entry bookkeeping and the double entry bookkeeping. You can only use the double entry bookkeeping if you have prerequisite knowledge of accounting, or if you don't have accounting knowledge, you are advised to stick to the single entry bookkeeping, which is relatively straightforward, and you all attain the same results. Emphasis here is on bookkeeping, how to maintain your books in a manner that a professional, any qualified accountant can pick up the records you have maintained and prepare accounting reports thereof. So we don't need to bother ourselves with the double entry accounting. But do remember that some accounts are debited while some are credited. The accounts that are usually debited are the first and the last. The first and the last, which is assets and expenses, usually debited. They usually have a debit balance. While the three in between, which is liability, equity, and revenue, they have a credit account balance. They have a credit account balance. So assets and expenses are usually debited, while liability, equity, and revenue, they are usually credited. So depending on what you want to achieve, if you want your assets to go up or grow higher, since assets are debited, it means your asset also will be debited if you want your asset to go higher. Imagine a company buying motor vehicle. The asset will go higher because of the introduction of the motor vehicle. It therefore means that the asset account of that company will have to be debited, and the credit now becomes either cash or payable, depending on if the motor vehicle has been paid for, is being owed. So just like I told us, I don't want to bore us with the act of debit and credit, because most of us do not have this accounting knowledge. But remember, whichever that works for you, if it is the single entry bookkeeping method that works for you, it's advised that you stick to it and you use it judiciously. So on this note, the class has come to an end, and the floor is now open for questions, comments, and observations. So if you have questions, you have comments, you have observation, I expect you to indicate by a show of hands. And indicate by a show of hands that you show your hands, or you go to the chat button and raise your hand. So we can see David Oluseyi has raised his hands. David Oluseyi has raised his hands. So can you unmute? Okay, David. You have been unmuted. Ross.
Yes, morning. Yes, morning. Thank you for shortly. Can you hear me?
We're struggling to hear you. Hello?
So my question is this: when we get, can you hear me now? Hello,
Yes,
sir.
I can hear you now. Go ahead.
My question is this: when we are giving the loan from the National Microfinance Bank, are we to forward a yearly accounting statement to them, or that whether they request for it or not, so as to know that, so as to let them know that we are making headways with the loan giving, or we are going to be forwarding account statements to them on request, about the debit and that their financial statements in total.
Okay. Thank you. If I get your question is on whether if you successfully secure this loan from National Microfinance Bank, whether you will be required to furnish your annual reports, annual accounting reports,
Yes.
National Microfinance Bank,
Yes.
or it will be on request. So if you get this loan, your account will not be mandated to be submitted to National Microfinance Bank annually. You will not be required to account annually. It will be on request. National Microfinance Bank will request for your account when they deem fit. And in most cases, when they request for this account, either some of the creditors, that's like you now, you become their creditor. Maybe people have started defaulting in making payments and all that, and repaying the principal and the interest of the amount due. That's the only way they call for your audited financial statement. Or in most cases, if the creditors, as the borrowers, want to access further funds, maybe you are applying to get additional loan from them, that's the only way they ask for your audited financial statement. But other than this, I don't think National Microfinance will request for your annual audited reports to be forwarded to them.
Thank you, sir. Thank you, sir.
Okay, any other comments? Any question? Any question? Any question? Okay, if there is no question, we'll drop the post lecture quiz on the WhatsApp platform. You're expected to make attempts on it. The link will be dropped shortly. You have just 7 minutes to make attempts. Okay, so the link has just been shared again. You have just 7 minutes to make attempts. The post lecture quiz and submit your answers, return your answers back to us. So on this note, nobody is expected to leave. Nobody is expected to leave. We are safe. No, Margaret, So chair, nobody is expected to leave. We are 6 in number. So I expect you to make attempts, the quiz, post-lecture quiz, and return your answers. Some of you did averagely well in the pre-lecture quiz. But, we know that the performance can be better after the lectures. Margaret has left. Margaret, you have to come back. Okay, Margaret is back. No one submitted. Nobody has submitted yet. Margaret has. Okay, she has appeared again. She's going and coming. Why is nobody turning in answers? Okay. Okay, somebody has sent in answers. Okay, somebody scored 100. This is impressive. So you scored 100. This is impressive. Okay. Means that you have paid attention to all that was said. Because he scored 60 pre-lecture quiz and now he's getting 100. Okay. This is impressive and encouraging. So shall you keep it up? The rest of you are still expecting your answers to be sent. Also, you have between now and the next 24 hours to do so. So by our time, it is 12 noon, and the class has to come to an end now to enable us to go concentrate on other activities. So on this note, ladies and gentlemen, we want to thank you, we want to appreciate you for your participation into this training session. It's expected that we converge tomorrow, same time, which is 10 a.m. for topic of tomorrow. So I want to wish you very goodbye for now.